Welcome back. You're watching the ET Money Show with me, Kavita Thapliyal. Now, signaling a further rise in lending and deposit rates, the Monetary Policy Committee of the Reserve Bank of India hiked the repo rate by 35 basis points to 6.25%. Now, the hike in repo rate is the fifth since May 2022 and is likely to push EMIs on vehicle, home, and personal loans higher. And with the central bank retaining its inflation forecast at 6.7%, it's clear that the days ahead may be challenging. Now, to decode RBI's rate hike move and what it means for you as an investor, we have on board Mahendra Jajoo, CIO, Fixed Income Mirae Asset Management India, and G Pradeepkumar, CEO, Union AMC. And good evening and welcome to the show, both of you. Mr. Jajoo, first question to you. How do you read the policy and inflation, even though cool down a bit is still a concern? You think the pace of cutting interest will soften going ahead?
Yes, I think in the current policy itself, we have seen that from a series of 50 basis points rate hike, RBI has toned down to 35 basis points rate hike in this policy. And then there were two people who dissented against the continued of stance of withdrawal of the accommodation. And then there's one member who dissented against the rate hike. So between the last policy and the time the RBI had to write a letter to the government to explain why the inflation has remained high in the previous 3 quarters, there has been significant change and improvement rather in the macro environment. We have seen the crude oil prices fall drastically, and now the crude oil prices are at around $80, which is the low of 2022. We have seen the headline inflation come down from a high of close to 7.5 to somewhere like 6.7, and then in the numbers to be reported in the next week, we are expecting the inflation to fall below 6.5%. The crops have been good, and as per the RBI's projections, also the vegetable and fruit and cereal prices are likely to moderate somewhat in the coming months. Generally speaking, all the commodity prices are off their peak significantly. Therefore, it is the expectation that the inflation will continue to moderate in the coming months. RBI's projection for the inflation is at 5% for the first quarter of FY24. And then, last but not the least, the growth projections have been revised down from 7 to 6.8%. And we have seen the trend that the growth projections are revised downwards with lot of hesitancy. So therefore, we can expect the actual growth to be somewhere closer to 6.5%. And therefore, I think the forward-looking expectation is for the inflation to ease, and therefore, at least the inflation is not looking to go up. It seems that the inflation has already peaked. RBI is already in an advanced stage of the current rate hike cycle. So while there is a possibility that there is one or two more rate hikes in the coming policies, at the same time, the market has also priced that in. So just to summarize, I think we are expecting a couple of more rate hikes, but then impact on the market will be mostly felt at the shorter end of the curve. So we continue to expect the yield curve to flatten, and the 7.5% is proving to be a very strong resistance for the 10-year benchmark yield.
Sure. So, Mr. Pradeepkumar, we are going in 2023 with recessionary and inflationary pressures. Talking about recessionary pressure, India more or less is comfortably placed and in fact would stand out. Talking about inflationary pressures, now because these are determined by global factors, not much can be controlled. How do you see RBI striking out balance here?
Well, I think, Kavita, we are relatively in a very good position. If you look at, all the leading economies across the world, we are probably going to be the only large economy which is also expected to grow at a meaningful rate over the next 4 to 5 years. So while RBI has reduced the expected GDP growth marginally, I think the focus on inflation will remain, and as some of the MPC committee members have already pointed out, if you need to wait for some time to see the effects of some of the rate hikes that have already happened. So if that view gathers momentum, I think the impact of the rate cuts that have already taken place will start panning out in the next few quarters. And in 2023, sometime during 2023, we should actually be seeing a kind of reversal, or at least the beginning of a reversal, in my view. So as the governor today said, the worst is probably behind us. And even as far as inflationary expectations are concerned, I think it's very important to note that all the assumptions, all the calculations of RBI are based on oil price at $100 per barrel, while even today it is below $80. And there are good reasons to believe that the oil price could stay at this level or even fall further. So if that happens, I think we may have some pleasant surprises on the inflation front, and as a result on the interest rate side.
So, Mahendra, now we really appreciate RBI's Main Hoon Na stand, okay? But then they've also reduced the growth forecast to 6.8 from 7%. How concerning is this? And do you think that this will slip further because of a global slowdown, which looks more aggressive now? Or you think that this is not there on the cards for us?
See, as you also mentioned, there are a lot of factors, especially from the global side, on which we have little control. And as the governor also said, that we are linked to the global environment, and therefore we cannot be completely detached and delinked. So, if there is a recession in the global environment, for example, we are already seeing expectation of IT companies earning getting moderated because of the recessionary impact in the US or in the European environment. So there will be some impact on the growth on that account, for which there is not much one can do except for the hope that the global environment improves. Then there is a domestic structural side of the GDP growth, which is, for example, the consumption pattern, and then there is a clear sign of improvement in the consumption in the rural segment. The consumer durables are also showing improvement. We are looking at a long wait time for the new cars. So the domestic consumption story is very strong because of the improving income levels and the aspiration levels of the public. And then we are also possibly at the door of a fresh capex cycle. So far, in the last few years, the capex was largely driven by the government expenditure. Now we have seen a few private large corporates announcing some capex plans. So capex improving will further add to the GDP growth, but the exports continue to remain a little bit of drag. So in overall picture, the GDP growth continues to be fairly robust, and therefore one cannot be too worried about 0.5% here or there, which if it is coming on account of the global front. And RBI has always been very supportive of the growth. Today in the press conference post the policy announcement, I think this was emphasized very clearly that the object of the monetary policy is to balance between the growth and the inflation. And we are now possibly at an inflection point where the inflation has possibly peaked and is now hopefully going to ease. And at the same time, with the COVID recovery largely being complete, the growth momentum is possibly requiring a little bit of a further push. Therefore, as the other respected speaker was also saying, I think we should see some sort of balance coming and the pace of rate hikes slowing down, and that should be helpful for the growth. So I believe that the RBI is doing everything in its control to make sure that the maximum possible growth is achieved.
Right. So, Pradeep, explain us. Now, a lot of rate hike or reducing the pace, it depends on a lot of data which central banks are banking on. Now, looking at the Fed signaling at reducing the pace of rate hikes, will that help us put a full stop for the same?
I think, what the Fed does is certainly going to have a bearing on what RBI does, because we are all integrated and India cannot act in isolation. Having said that, the kind of pressures that Fed faces in US and what we are facing in India are a little different. in the sense that while RBI is very much focused, as the governor said, with that Arjuna's eyes on the inflation, there is always the question of balancing growth, with the inflationary target in RBI's mind. So our situation as far as the inflation growth balance is a little different compared to US. So while, if US slows down the rate of hikes, it is definitely going to make life a little easier for RBI. The pressure on RBI to keep increasing rates will ease to some extent. However, primarily, I think RBI's actions will be driven by data and data coming from our own economy, Indian economy. So I think they will have a single-minded focus on what are the inflationary data and the expectations that are there in the market. So it'll be driven more by that. But I entirely agree with you that if Fed is becoming less hawkish, RBI's life will be a little easier.
Mahendra, let's talk about bond yields now. Is there more room for bond yields to go up, or you think everything is factored in now?
So if we extrapolate the current environment, for example, in the press conference also, there was repeated reference to the fact that the reduction in the pace from 50 basis points to 35 basis points is an indication. If the Reserve Bank is going to be data dependent, and if we look at the current set of expected data, one would expect lower commodity prices, a little bit better geopolitical environment, and a slowdown, kind of slowdown, if not recession, in the global economy. So all are turning slightly more favorable for the fixed income, and that is coming at a time when we have had a very accelerated rate hike regime, and therefore at this point it is fair to expect that the market is pricing in, at least for India, a terminal repo rate of 6.5%, and even after today's hike, the Reserve Bank is at 6.25%. So market is already pricing in one additional rate hike of 25 basis points. In US, if you look at the Fed rate projections, market is already pricing about 5% of the Fed rate hike. So that information is known to the market, with an understanding that the Fed rate may go to 5%. The 10-year yield in US is trading at around 3.5 and 3.6%. In our earlier discussions also, we had discussed that 7.5% is a very strong resistance for the 10-year yield, assuming 100 basis point spread on the terminal rate of 6.5%. Therefore, incrementally, the impact of the further rate hikes will possibly be felt maximum at the short end of the curve. For example, from tomorrow, we might see that the money market rates go up by another 10 to 15 basis points, because the overnight rate will move from 6 to 6.25. So the curve will get flatter, and then if suppose there is another rate hike by the Reserve Bank, or there are 3 more rate hikes and RBI goes to 6 and 75 or 7%, the yield curve in India also will tend to get inverted. Like in the US, we have now 2-year yields at around 440 and the 10-year yield at around 360. So in India also, if the macro environment continues to improve, if the inflation trajectory continues to stabilize, then at some point the curve will maybe become from flat to slightly inverted. So considering everything that we know today, and considering what we expect about the next 6 months or 1 year, I would expect that the 10-year yield should remain centered at around 7.5%. Obviously, there is no immediate reason for the yields to fall dramatically. And then, when the next rate, next round of rate hikes happen, the short-term rates inch up by a similar margin.
Pradeep, what will you say? Do you think the concerns with which we began the year 2022, we are ending on a softer concern note, or you think that we are entering 2023 with similar kind of concerns?
I think, Kavita, we are in a much better situation compared to what we apprehended, what we were apprehensive about in the beginning of the year, in say January 22 or December 21. There were a lot of concerns and about the global situation and the inflationary risk and the slowdown, etc. I think probably thanks to the sustained efforts of various bodies, including RBI and the Government of India, etc. We have, I think, managed to weather this fairly well, which is why today we are in a position to talk about interest rates peaking out and India continuing to grow at a healthy rate, and particularly compared to any other economy in the top 10 in terms of size, we are growing at a much faster rate, and we are expected to grow at a significantly faster rate. In fact, IMF expects that during the 22 to 26 period, 4 years, India should grow on an average at about 6.5%, which is a real shining story. So I would think that we are going into 23 in a much more positive frame of mind, and with significantly better expectations about our economy, economic growth rate, and of course about the markets.
All right, and we expect this positive sentiment and note to continue further. Thank you so much, Mahendra and Pradeepkumar, for being on the show and helping our viewers understand the integrities of this RBI monetary policy today. And with that, it's a wrap. But then before I end the show, we want to give you our WhatsApp number and our email ID where you can reach out directly and send us your portfolio queries. WhatsApp number is 865-797-4571 and the email ID is themoneyshow@etnow.tv. Please remember, once you send your queries, we will give you a call and we will take up your queries live on the show so that you can talk to our financial planner or our expert panel on that particular show. So do send us your queries. That will be all. Thank you so much for watching. Goodbye.